All right, very good. So we are accounting for, right, we are accounting for material, labor, and overhead. So most of this, I think, was in the second assignment. Right, most of this was in the second assignment, but we'll just peruse through the important things here, right? And then we'll proceed from there. All right, so first of all, the definitions of material, what we'll be talking about when we deal with material. So you must remember, initial stage, when we're talking about the classification of costs, the initial stage of the module, we spoke about the classification of part of the costs we're dealing with direct materials, right? So we are picking it up from there and then looking at the accounting records of these materials. Right, material refers to the group of costs that include all physical material converted into products during the manufacturing process. So indirect materials and other consumables can also be actually going to be included here as well. So direct materials, what we mean by direct materials, if you are not saying, suppose you are going to be manufacturing food, an example of direct materials, example of direct material is something like labor, something like the leather that you buy and then you put up there. That's the example of direct material. And then when you talk of indirect materials, you refer to indirect materials. Okay, just give me a second, sorry. Indirect materials will be referring to things that are not directly going to be linked with the production there. Something like cleaning materials. Let me just put something here for the child. Just a second. All right, I'm back now. I just hope I'm not going to be interrupted. All right, so we're just distinguishing there between direct materials and indirect materials. So if you're going to be calculating your prime costs now, then prime costs are a combination or a total of all your direct costs. So which means necessarily you're going to have your direct materials included there. But once something is written in direct materials, then you will have to deal with that one differently, right? And then part of what was there now in the assignment was about one of the options I think that we saw there had to do with the material requisition form. I think this one you could have easily picked it up from the study guide here. But it's just about the procedures that we go about whenever we are buying the material, right? Buying the material. So like anything, if you have seen what happens in companies, I think the one company that I once worked for, I wasn't exactly in the manufacturing division, right? But at the end of the day, whatever division that you are in, we always had to do requisition forms, right? If there was any kind of material or any kind of inventory that you required for your department, you needed to fill up a requisition form. All right, but in any case, some of the things that we need to be aware of, that or some of the documents that we need to be aware of whenever we are dealing with the material is the first one, of course, the GRN, the goods receipt note. So this you will hear quite a lot of in auditing. But when materials, in this instance, when materials is being delivered to the organization, there is what we call a goods received note, right, which is going to specify the quantities and the description of the product, right? So this is to ensure that what is being received is basically meeting the criteria, or it's what we actually want. Is it the right quantities? Is it the right quality of what we want, or the right description, rather? Since probably at that stage, it's not easy to exactly tell the quality, right? But you want to identify, if you're working for an organization, you want to identify, if you are a receiving clerk, for instance, you want to identify if there are any breakages in the material, right? Or if there is anything obvious in the packaging at least. And then maybe where possible, check the packaging and see if the description in the paper actually meets the package. Description in the GRN actually goes hand in hand with what's in the package. All right. But then for starters, again, we have a material requisition form which identifies the raw materials to be issued by the materials clerk to be used in the production. Right. So you have your material that has been received, right? So the material is now in the warehouse, and then these materials need to be issued to production. All right. So in order for it to be issued to production, then it's a request form, right? We do a material requisition form where you are basically saying, okay, this is how much we need of the material, and then it's going to be released there from, which is going to be released there from the storeroom in most cases, right? So the quantity from the GN and the value from the purchase order. So the purchase order is going to give you the quantity, of course, and the value, right? So the purchase order is most likely going to tell you how much it's going to cost you per unit, and then the total cost again and the number of units. And then the GRN is only going to give you most likely just the quantities, right? The quantities and the description. So all of those should match again. But bear in mind that this differs with the company policies, right? You find that you go and work in another company, they do things slightly different than the company that you were at before. But the principle is the same, right? The principle of accounting there is just the same. Right. So in addition to, right, let's see, for individual items of materials, and then these are going to be recorded in the materials inventory ledger system, right? They are going to be recorded in the inventory system there. So in addition, showing these quantities, of course, prices for each of the materials received, issued, and on hand is going to be important for the accounting records there. All right, and then we will also distinguish between the perpetual inventory system and then the periodic inventory system. So this is also in the first year modules for FAC modules, first year FAC modules, right? So the perpetual inventory accounting system is used to record the movement in materials inventory. So if it's perpetual, we are entering each increase and each reduction of inventory in order to maintain an up-to-date materials ledger records. So this one is normally used. Right? This is the one that is normally used. So a big sign, if you go into an organization, a big sign that they are using the perpetual inventory system is when you have an actual inventories account. Then you know they are keeping track of inventory on a day-to-day basis. So this would be opposed to the other one, is the periodic system. So the periodic system would actually make use of a purchases account there instead of the inventory account. All right, and then the physical inventory account, this is what we are talking about, which must be done from time to time, usually at the end of the financial period, to determine the correct value and the quantity of each inventory item separately, right? And of the inventory in total. Right, so this is updated day in, every day, basically on a daily basis. It's updated on a daily basis, so that at the end of the day or at the end of the year, we basically have a value of our inventories, right, to assist us in getting our opening and closing inventories. We check that from the inventories account, the physical inventories account, right? All right, and then so usually we have, okay, so this is account, sorry, that we're talking about. So then usually at the end of the day, we'll need to compare now what is in our books in terms of what we have recorded on a daily basis right up until the end of the year to get the value of the inventory against the stock count, right? Against the yearly stock count. I think if you have also worked in an organization before, most of the time there is a yearly stock count, right? An annual stock count, which could be for some organizations somewhere around January, February. That should basically give the organization the actual quantities of inventories that they have on hand at that day. So that will then have to be compared with the inventory account to see if it's the same. So we hope that it's the same, then any discrepancies are going to be resolved there. So for some organizations, stock counts happen on a weekly basis, or for certain product lines, they will be on a daily basis, right? So this is to prevent a situation where at the end of the period you have a very huge variance there, or a very huge gap between the physical stock and the stock value according to your accounts, right? So the daily counts are such that if there's a discrepancy, it has to be corrected before it goes any further, right? So there are a lot of benefits for that, but we don't cover that in this module, right? So when we talk of physical inventory counts, so it's not exactly going to be at the end of the year. Sometimes it's right through. We want to continue updating the books right through, right? So that you don't sit there with an inventory theft of, most of it is going to be attributed to theft, right? Losses, maybe losses and damages, just a few of it is going to be attributed to that. So you don't want to sit at the end of the day with a very huge figure for that at the end of the period, when it could have been addressed during the period, right? Sometimes you want to check for expired inventories, etc., and then fix those things and claim. Sometimes you want to claim for insurance, etc. All right. And then from there, the cost of acquiring material. Right? What is the cost of acquiring material? So is that all costs incurred? So these are all costs that are incurred in getting a unit of material, right, into its current place condition. So in other words, every cost that is going to be involved in bringing this material to our premises, right? And it must be in the condition that it must be usable, right? It must be usable. So, which is going to include the acquisition costs, such as suppliers' invoice price and the transportation costs. Most of those, right? Most of those are the ones that are going to be included there. And then sometimes we could be dealing with imported inventory. So in those circumstances, you watch out for customs duty and shipping costs, etc. So the guiding principle there is, if you're going to be dealing with imported costs, there are some costs that you can claim back, right? There are some costs that you can claim back. So those ones, you don't want to include them, right? You don't want to include them. You only want to include those costs and taxes that you can't claim back for the most part. But in any case, that's in IAS 2. We don't cover that in detail here. But what's important particularly is the transportation costs and the invoice price, And then of course, customs duty and shipping costs, etc. All the costs that are incurred in bringing these products right here. All right, and then the accounting entries for that, right? So the material inventory is an asset, right? So you expect that you want to debit an asset all the time. It must increase on the debit side once you see that debit. So whenever you make a purchase, the first thing to do would be to debit the inventories control account. Then on the credit side, it's either the accounts payable. Sometimes it could be, so if it's accounts payable, it's most likely that you have acquired it on credit, but it could be bank again, right? Hence you see that's less back. So once it's you've made a bank transfer, you've paid cash, then you simply take it to the bank. Yeah, you are gonna credit the bank. right? Now, what happens when the raw materials are issued to production? So this is the first journal. There is when you are receiving the inventory, when you are purchasing inventory, right? Then the second journal now we deal with when it's being issued to production, right? So direct materials, so this is what we came across in the assignment. Direct materials is recorded as work in progress, indirect materials as manufacturing cost. So there is a big distinction between those two there. So manufacturing overheads, these indirect materials are going to be going under consumables used for maintenance of the factory. Right. So these indirect materials, remember, we say they are not exactly directly linked with the production, right? Something like cleaning materials. If you talk of cleaning materials, maybe things like oil, if you're going to be buying oil to grease the machines, you see, it's not exactly a direct material. It's not like the leather that you're doing. So the manufacturing company that I was working for, by the way, we were printing newspapers. So when you're printing newspapers, you have the direct materials, which is going to involve the paper that you buy and the ink, right? And that's going to be the direct materials. Then when you're greasing those machines, then that's going to be indirect materials. So if you buy that grease, or you are going to be buying that oil, it's going to fall under your indirect materials, right? So it's a consumable. All right, so what happens there? So at the end of the day, once you go and buy, say, the oil, right, it is stock, it is inventory at the end of the day. So it will go under your materials inventory account. So it's going to be debited there. But the difference now comes to when it's being issued to production. One is being issued to production as work in progress, but the other goes as a manufacturing overhead because it's an indirect material, it's a consumable, right? It is also treated as a consumable there, right? But again, there are distinctions, right? There are distinctions between consumables that are used for maintenance in the factory, like the ones that I'm talking about. These are the ones that go there under indirect materials, right? And then other consumables like stationery, etc., right? Those ones are non-manufacturing, right? You need to watch out for that. They are non-manufacturing. So if you remember on the notes, non-manufacturing costs fall under period costs, right? Those ones would fall under period costs, so we don't include them in our manufacturing costs. All right, so there we go. That's the second journal there. So with direct materials, you debit them to the work in progress account, and then with indirect materials, they are going to manufacturing overheads. So only to the extent that these indirect materials, only to the extent that they are used in the manufacturing process or in the manufacturing plant. Right. If it's oil that is used to make oil just in the office, you don't include that there. Right. And then it goes again, all of those are gonna be, or those two are gonna be credited in the materials inventories there. Then again, if we do have, like I said, non-manufacturing overheads like other consumables, stationery, for instance, the paperwork, all that is office work. So in as much as we're gonna credit the materials inventories account, it goes to a different debit, which is under a period cost. All right, and then all returns from production or other departments to stores result in credits in the work in progress account. So again, we are dealing here with, when we deal with the work in progress account, we are dealing with direct materials. So if there's an instance now that the direct materials that we issued there is being returned back to the storeroom, then we reverse the first journal there. So the first journal was a debit. Sorry, the first journal, the next journal, sorry, was a debit to the work in progress and a credit to the materials inventory. So we want to reverse that now. then we do a debit to the material inventories account, then we create work in progress account. So we are basically removing it there from that account. So what would happen now for the work in progress? It can basically be repeated if it's indirect materials that is being returned again, and then if it's maybe stationery that is being returned again to the office, then we do that there. All right, so this is the example that we have there. Right, so the material inventories account, so that's DT there, DT in brackets is supposed to be DR, right? It's supposed to be DR. So those are the balances there on the 1st of March. Materials inventories, it has a debit balance. So all these we expect that they will have, all inventories, we expect that they will have debit balances because they are assets. And then we have an accounts payable there, a credit of 30,000, right? And then these are the transactions now. We purchased materials on credit for 38,000, right? So if it's a purchase on credit, then we know it's going to the accounts payable there. So the accounts payable increases on the credit, so we need to credit the accounts payable. What are we purchasing? We are purchasing direct, right? We are purchasing direct material, right? So it goes to the material inventories account. That's that 38,000. So we are basically doing that first journal, the journal number 1, materials inventory. And then on number 2, materials issued. So when we're dealing with materials issued, this is now on journal number 2. So direct materials, this one is going to be issued to the work in progress. We discussed that one. Indirect materials, this one is manufacturing overheads, right? So under the assumption that this is still this indirect materials used in the production process. So you're basically going to debit your work in progress, and then you credit your materials inventory account, and then you debit again your manufacturing overheads and credit your materials inventories account. Very straightforward there. So these are the T accounts for that. So most of the questions that we get with regards to this most of the time limited to what we had in that assignment there, the multiple choice questions. So they are most of the time limited to that there. Then what's likely to come out now on our next assignment is stuff on inventory planning and inventory control. So what are the reasons why we brought inventory? Inventory is such an important part of an organization, such that particularly for organizations that do retail, right? Organizations that are buying and selling, right? Even organizations that are manufacturing. So as long as you're going to be dealing with physical inventory as your output, then inventory is going to be very important in the organization. Both its valuation and how it's kept, it's going to be very important. Right. So what are the reasons for holding inventory? Number 1, transaction motives, right? This one we also had, I think, in the assignment where we spoke about holding inventory for day-to-day use in production. So we are basically trying to meet your production needs. When we say a transaction motive there, that's what you want to do. You basically want to meet your production day-to-day needs. You don't want to have a situation where you are running out of your inventory, right? And then precautionary motive. So this refers to holding extra inventory when future demand is uncertain and the supply is unreliable, right? So precautionary, that's why you find opening inventory and closing inventory, right? That's a precautionary motive. Sometimes demand fluctuates, right? Demand fluctuates. So you don't want a situation where the demand has fluctuated and you are found wanting it as an organization. You don't have those goods in stock, right? To meet your production needs, etc. Remember, sometimes production can also be disrupted. Like in our case now, they could be load shedding, like load shedding can disrupt production. So those disruptions, you must always have inventory that is kept for such days, right? You call your supplier, you need some material, supplier says, sorry, we'll only be able to manufacture that tomorrow or after 21 hours. So you must have something held up, right, for such times. And then speculative motives, right? Speculative motives. This is when you are probably anticipating that there's going to be shortages, right, or an oversupply. But for the most part, when there's going to be shortages or sharp changes in prices, right, you are speculating. You are basically going to be speculating. I know certain products, if you are a king in that market, your suppliers will let you know that we are not going to be having supply for maybe within the next, after 3 months or so. So what you could do under those circumstances, maybe you could buy your inventory back. You see, maybe sometimes if there is a new product or a new product line that's going to be brought in the market and the other one is going to be discontinued, then you want to hold less of one that's going to be discontinued. So you sell that off if you don't buy, you don't replenish the stocks of that. So that's speculation, right? So those are the three motives there. All right, and then what we're doing now on from 4.1 builds up to EOQ, economic order quantity. So at the end of the day, we agree now that we need to, there are three reasons that we need to keep inventory, right? But as an organization now, is there a quantitative way of us getting the best amount of inventory to order or the best amount of inventory to keep, right? Bearing, of course, in mind that in keeping inventory, in holding inventory, there are costs that are associated with that, and then there are costs again that are associated with not holding inventory. So we need to try and strike a balance on that. So we are building up now towards calculating what we call the economic order quantity, right? So let's start off with inventory carrying costs or inventory holding costs, right? These are relevant costs. So remember the definitions of relevant costs there. So inventory carrying or holding costs are relevant costs of keeping inventory on the organization's premises until it is used and includes the costs such as the handling costs, the warehouse and storage costs, insurance, and obsolescence costs. Right. So the relevant costs are only those costs that change with a change in inventory levels. So obviously, if you look at insurance, for instance, if you're going to be charged insurance per unit, it is of course a relevant cost and it's cost that you incur for keeping that inventory. So if you not bought that inventory, then you would not incur that cost, right? So whenever you see carrying or holding cost, then that's what we are referring to there, right? Sometimes, because we already defined cost, I think, on the first session, sometimes there are costs such as opportunity cost, right? The forfeited cost. If you consider that if you are pumping out funds as an organization to get yourself some inventory, because those funds could have been used for other productive things, like maybe you could have got short-term investments, you know, using that money, but you've decided that you're going to buy inventory and keep in the warehouse. So sometimes the opportunity cost of that is included as a holding cost as well. But yeah, that's the interest incurred or forfeited as a result of a unit's purchase and is usually expressed as a percentage of unit price. That's the one there that I'm referring to. But for the most part, I think that one you normally deal with, you normally incorporate a third level. Right? Now, holding costs are just put in there as holding costs. All right. So the first example there, the first activity is a straightforward one. We are calculating the average inventory on hand. Sorry, the average inventory on hand. So X Limited orders inventory in quantities of 100 every 10 days. So usage occurs evenly. So which means it's the same quantity per day. So calculate the average inventory. So that's going to be as simple as dividing the order size and the order interval. So it will give you the average inventory per day. Yeah, so And that one is quite straightforward, right? All right, so, okay, let us see now. Okay, I think that one there you can leave out. All right, let's deal with ordering costs. Right, let's deal with ordering costs. So ordering costs are the relevant costs of ordering inventory and may include delivery and transport costs, as well as administrative costs of preparation and processing the order. So remember, what you need to be mindful of here is ordering costs don't include the purchase price. Right? Ordering costs don't include the purchase price. We are simply talking about the cost to place an order. Right? And a very good example of that is the administrative process that you undergo to place an order. So which means the clerical work, the paperwork that goes into that, transport costs. Right? That's the cost to place an order, not so the purchase price. Right? So if the purchases are made in small quantities, then the result will be frequent orders. And then obviously, if the orders are frequent, then the corresponding costs are high, right? Because you incur these costs as you place orders. Right? So basically, if the paradox of it here is, if you look at the inventory situation there, let's say you are overstocked, right? So if you're overstocked, there's a likelihood that the size of your orders are large, right? And then the frequency of your orders are lower, right? So if that's the case, then your ordering costs are going to be low, and then the annual carrying costs are going to be high, right? Then if you're understocked, in other words, if you're not carrying a lot of stock, then it's likely that the size of your orders are small, right? And then you are making these orders frequently. And then if you're making the orders frequently, then the ordering costs are high, and then the holding costs are low. Right? So ordering costs and carrying costs are always moving in opposite direction. Right? So for the most part, when the ordering costs are low, then the carrying costs are going to be high. And when the ordering costs are high, and the carrying costs or the holding costs are expected to be low. Right? So that one you can easily predict right there. And then the economic order quantity. So this is what we're building up to. So it's the quantity of inventory to be ordered at a time in order to minimize annual ordering and carrying costs. So we want to keep these at minimum, right? In other words, we just want a balance between those two. We want an equilibrium between those two. So where it's not too high and it's not, in other words, the lowest it can go, actually. The lowest it can go. So bear in mind that this is coming in the context of that when one is high, the other is low, right? So you want to get a formula that gives you a conclusion or a result where it's the lowest, right? It's the lowest possible combination of the two costs, right? So let's have a look at, I normally like to go straight to the formula on that one and work with the formula on that one. Okay, I think the formula is probably on the next session there. All right. The rest of these here, it's giving us, all right. All right, the economic order quantity there. All right, determining the economic order quantity by means of a table is a lengthy process and may not provide you the accurate formula. So the formula is the square root of the fraction whose numerator is twice its product, etc. So what should have been written here on 2UC and HPI should actually be the square root of, so the square root being big there, right? Square root of the answer that you get after you divide that. Yeah. So what is 2UC and then what is HPI? Right. So U is basically usage. So sometimes it's gonna be written as D, right? Sometimes it's gonna be written there as D, which is the annual demand or that periodic demand that you are dealing with. Here they decided to put it as U, right? So it's 2 times the usage, or which is the demand, and then you are also going to be multiplying that again with C. So C is the ordering cost. So some textbooks are going to put that as O there. So it's basically 2 UC, which is 2 DO according to some textbooks, and then there it's supposed to be divided by H, which is the holding costs, right? Which is basically the holding cost. So that IP is the one that we're talking about there, which is the required interest rate times purchase price. Yeah, it basically gives you the opportunity cost of holding inventory. The opportunity cost of holding inventory. But you hardly get that. But if you do get that, you are going to be given an interest rate, right, which is either the weighted average cost of capital, or it's going to be KE, right? They are going to give that to you. So you simply multiply that by purchase price, which gives you an indication of the return that you are losing out while you are keeping that inventory. Yeah.
Sorry to trouble you there, Ntando. Just want to ask something here. When you say 2 UC divided by HPI, what do you mean? I see the abbreviation, the definition there, but 2, does it multiply? Does it add? What is happening with that formula? EOQ.
Okay, it's a multiplication. That one is a multiplication. When there is no sign there in between, it's a multiplication. So 2
okay.
UC.
Noted. You answered my question. Thank you so much.
Yeah. Right. So the only thing that's missing there is the square root sign that they should put up there. It's the square root sign. So for some reason they didn't put it up. But the correct solution has to give us a square root sign. All right. So I think all right, that there you can as well ignore all of that. And then we work with, I think we'll work with correct assumptions. I just don't know how this study guide was being written here. But I think next time then we'll get a good question from this. I think there are a lot of questions that we can get, even on the textbook that I'm gonna throw up there in the group. It's gonna have examples of that.
I'm more interested in calculating WIP. That one I know for sure. It's a problem most of the time. Maybe if we can calculate maybe using different criteria in the question, or maybe using old question papers, that would be much better, just to understand the insight of this WIP.
All right. Let me explain first of all. You know what WIP is? Eh? Let me.
I just know